Fed minutes due out tomorrow from the central bank's last meeting. Meanwhile, CPI last week slowing and showing some inflation. I shouldn't say slowing. Inflation rising more than expected in January. Join us right now for more on the Fed and the economy. Richard Fisher, former Dallas Fed president, now Barclays senior advisor, CNBC contributor. We talked to Lil Brainerd about this earlier today. There was this sort of sense, Richard, and I remember last time, I think you were sitting here in person, we talked about where the economy was. It felt like an A, I think you said. You said it's an A. But the question is, if inflation is really not coming down as much as some people had anticipated, is it really an A?
Well, it's moving. It has moved in the right direction. You're going to have some bumps along the way. Obviously, the expansion continues, even if it's slowing. The unemployment numbers are very, very low historically. As we just had a discussion from the previous person you had on, consumers have surprised, even though they're moving down the price ladder. So I think there's no need. I think the bottom line here is there's no need for them to do anything in March 18 and 19 when they meet. And the question is, do they do anything at the last day of April, first day of May? We'll see. But what we are going to get, Andrew, is a sense of the dot plot, as it's called, the SEP, after the March meeting. And I think that's what I would be paying attention to and how they express themselves after this next meeting.
And how do you expect them to express themselves at the end of this meeting?
I think they will continue to reiterate the word sustainable. And if they can do that, that'll just send a signal to the market. We've gone through the silly period with market expectations, 6 cuts this year. So much of that is just wishful thinking, in my view. The fact is the Fed continues on its path.
Right.
What's driving the yield curve is also the massive federal borrowing that's taking place. The auctions in the 10-year have gone fairly well. As you know, they've front-loaded more of what they're trying to refinance. A third of the U.S. government debt's going to be refinanced this year. It's a big number, 10.1 trillion, I believe. So there are these different cross currents here. And I think the Fed is not the only thing you should be watching here. You should be watching
Richard,
financing.
Well, let me ask you about the financing. I don't know if you remember when Stan Druckenmiller made the argument that effectively the Treasury Department needed, I think previously, I think it's hard to do now, to have taken advantage of lower rates. Are you a believer that the government should have been more aggressively thinking about how to effectively hedge the portfolio?
It wasn't just Stan. Janet Yellen herself said, go big when rates were nil. Remember, the cost to carry now for the U.S. government has doubled and will continue to along that path, with the balance of risk being for higher rates, not lower rates, particularly as you move out the yield curve. So yes, he was right. And Janet Yellen, let's give her some credit. She was right. Go big. But guess what? The dealers will not accept 50-year paper, which everybody was suggesting, certainly not century bonds. But we should have issued more when rates were hovering around.
The question is, could we have? I mean, there are people inside the Treasury Department that say this is a ridiculous argument because while the market would not have, the market wants a consistent offering effectively, and that the second you show your hand and say, I'm selling, this number of bonds at this price. I mean, by the way, we've already done that a little bit. That might ultimately impact the price itself.
Well, that's an argument. I disagree with it. We had an opportunity to do two things: issue a large amount when money was near free. The interest rate was about 2%. And we had the opportunity to go very, very long, which several other governments around the world have done. Several universities in the United States have done. Several cities have done. Even Washington, D.C. has done. So we missed that opportunity. But that was then. This is now.
Right.
We'll see how the auction schedule proceeds. But remember, Andrew, these are big numbers. And the question is, can the dealers and the market digest all this as the Fed is reducing its balance sheet?
Richard, do you have a view on the other big headline of this morning, which is this Capital One Discover deal? I think a lot of people had been expecting it or thinking that this is sort of a natural combination, but thought maybe the regulators would not approve a deal of this magnitude.
I don't have a view on it. I mean, banks obviously like to be on the credit card side, and so I don't have a view of this transaction.
No, I just didn't know with your Barclays hat on whether you looked at it and said that this is actually a good. I mean, there's an argument to be made. This is good for competition insofar that if you're Visa, MasterCard, Discover has not been a real player in the past couple of years at a minimum, and potentially if you start to funnel all of those Capital One customers, at least some of them, onto the rails that are Discover, maybe it changes the dynamic. I don't know.
Well, I think it's good for more competition. It does change the dynamic. We'll just see how effective they are with that property.